Welcome back to the Investing on the Go podcast brought to you by FundCalibre. Asia is often seen as a high-growth region weighed down by persistent risks. This week, we explore what investors may be missing, how the opportunity set has evolved, and why structural changes are reshaping the region.
Hi, I'm Joss Murphy, research analyst at FundCalibre. Today, I've been joined by Shan Zhang, investment specialist on the Baillie Gifford Pacific Fund. How are you, Shan?
Very well.
Great to hear. Well, let's kick things off then. Shan, when people think about Asia today, sentiment still feels quite mixed. From your perspective on the ground, what are investors getting most wrong about the region right now?
Thanks, Josh. That's quite a good question to start with. When people think about Asia, the first things coming to mind is it's big, it's growing fast, it's got a lot of people living there. But in the decade until pretty much to 2024, as an asset class, Asia ex-Japan equities have pretty much underperformed the developed market, especially the US. So is it right to say that the economic growth in Asia simply didn't translate to equity market returns? But what really happened from what we observed on the ground is there have been fantastic companies and are actually growing, but there were also two very strong headwinds against the asset class. Number one is US dollar has been really strong over the past decade until pretty much earlier last year. And then number two is there have been several years that China hasn't done well. It's very, very pessimistic sentiments towards China amidst a number of things, a regulatory crackdown on the technology sector. If you recall that back in 2021, also there were COVID, last for a few years. And then also there is a property market meltdown. So there are several macro headwinds against the asset class. But arguably, we see both of these, strong dollar and pessimism about China, have been abating in 2025. That's why you see Asia has flagged out as one of the best major equity markets that has delivered last year. The other thing I would say, people read a lot about the headline news about tariffs. If at the beginning of 2025, we just had a Trump administration, I told you the world will be in a trade war. There would be a lot of tariff saga. People wouldn't naturally think about Asia would perform well in that environment. But however, what really matters for a lot of the Asian companies are actually domestic economy and domestic activities rather than tariffs and trades. If you look at China's annual retail, the annual retail is 10 times larger than how much China exports to the US. Even if you look at India, about 75% of listed Indian companies' revenue are earned domestically. So for these large economies in Asia, domestic activities and policies matters a lot more than tariffs and global trades. And I think that's one thing that people have probably not talked enough about.
Yeah, it's definitely fascinating to see how well Asia's thrived, particularly in the last year. But just touching on a few things you've said, how different does the opportunity set in Asia look today compared with, say, 5 or 10 years ago, particularly for long-term growth investors?
I'd say massively, both from macro and micro perspective. From macro perspective, I think most of the Asian economies have gone more resilient than before, thanks to the more orthodox policies they have adopted during the pandemic. I mean, they're comparing with Western government, they haven't been printing money aggressively, have had a quite prudent monetary and fiscal policy, and that has resulted in good fruit. I mean, reasonable inflation, better FX reserves. You look at every macro metrics there is more resilient than the previous cycle of global crisis, so to say. And then what makes us as long-term investors even more excited is the micro opportunity. Asian companies, a lot of Asian companies are increasingly at the forefront of deep global structural trends, whether it's about AI, CapEx, and hardware producers, green transition enablers, or even rising domestic brands for rising middle class in Asia, and just the level of innovation that we observed from the ground is materially stronger than before. I mean, if you look at more than 10 years ago, you probably can name a few globally competitive Asian companies, but now you can count a lot more of that. So the universe for us is no longer just very boring banks, utilities, and energy companies, state-owned, etc. But there is a genuine broadening of innovation-led companies that is embedded in the forefront of several big global trends.
And then, how do you think about macro risks? Geopolitics, policy intervention, supply chains.
Yeah,
in them overwhelm the bottom-up stock selection?
I think both macro and stock selection are important in the sense of being a successful long-term investor in Asian equities. There are cyclical opportunities that could brought by big macro trends turn as well. I think the key thing here is to think about the potential winners and losers in each scenario. Geopolitics, policy invention, supply changes can bring challenges, but can also bring opportunities depending on what industry it is, what stage of different industrial cycles or commodity cycles it is, and which side of the supply or demand you are in. Giving you probably two good examples here. One is when people think about export control, U.S. Export control on semiconductor bans to China. It's not good news for the progress of a lot of Chinese companies, but on the other hand, it's also forced a lot of Chinese companies to work together with each other to cultivate a self-sufficient domestic semiconductor ecosystem. And we've been looking at those closely and then found some good investment opportunities within that. They are increasingly taking market share in the domestic market. A lot of their buyers want to onboard a second supplier in addition to their foreign supplier. So that's one of the examples there. The other example would be when we think about supply chain repositioning. It's not realistic to think about everything will be repositioned back onshore to the US. The likes of Vietnam, who are still a leader in a lot of very labor and manufacturing incentive goods. Just the wage difference between the West and countries like Vietnam is still huge. So it doesn't make sense to reshore at all. And then countries like Vietnam in the middle between the US and China geopolitical divide can actually try to benefit from both sides. So we see Vietnam really on a good track. And in our Pacific Fund is one of our largest off-benchmark allocation.
Very interesting, Shan. In a recent Insights piece, you talked about an opportunity gap in Asia. What do you mean by that? And why do you think it's become so pronounced?
I think in a nutshell, what I mean by that is the economic gravity has shifted to the east. We all know that Asia as a percentage of contribution to global GDP growth has been growing. And then most of forecasts, if you look at IFM, etc., would foresee that to be continuing in the foreseeable future. But the investment gravity hasn't. when you look at global portfolios, the allocation to EM to start with is relatively light. Most of the global managers are still underweighting emerging market, and Asia is pretty much 80% of the emerging market. So people's allocation from an investment perspective have been relatively light. I mean, arguably that has been the right allocation, as I mentioned at the very beginning, that in the previous decade, Asia has actually lagged. I mean, the right choice would have been investing heavily in the US or developed market. But the key question is what coming next? If we think about both of the macro and the micro are aligned, as I said, in previously, and also two of the previously very big headwinds, the very strong US dollar and severe pessimism about China, both of them have been abating. We do think conditions are aligned for a gradual reallocation from global investors back to Asia as a class.
Yeah, it does look like some of those headwinds are dissipating, particularly with how well the market's been doing at the moment. Which parts of the Asian market do you think are most affected by this gap, and where do you see it starting to close?
I'll probably point out to four areas, or to say four themes that we're very interested in. The first one is AI hardware. So this is perhaps not too new, but we do think there's very promising prospects for that. So the code I would always like to say is like AI capex keep going, but it's keep going east. But when you think about the choke points of all these hardware manufacturing for the AI capex, data centers, computing, etc., is mostly dominated by Taiwan and South Korean companies. And in the sense that hardware expertise comparing with software expertise is very difficult, much more difficult to replicate, much difficult to replace. So we also think the risk reward dynamics are different. People talk a lot about AI bubble in the US hyperscalers. Are they going to make a good return from their investment? But we are more thinking about AI resilience. Part of the reason is the hardware expertise is very difficult to replicate and to rebuild by anywhere else. And then number two is also like no matter who win the final AI game, they all need logic chips, memory chips, and there's only a number of companies in the world can do the best advanced ones. That's number one. Number two would be the rising of the advanced manufacturing. It's quite linked to this as well. So it's the things of the likes of modern batteries, efficient energy storage systems, electric vehicles, industrial robotics, etc. Asian companies are getting the forefront of that as well because of the innovation and the scale they have. The third one I want to mention is the rising of domestic consumption brand or domestic operators. So the likes of China and India have very big domestic market, and their consumer preferences are shifting. So whether it's from Chinese people drinking more coffee, comparing with traditionally drinking to tea, and then there's domestic coffee brands like Luckin Coffee are doing very well in that context. If you look at India, we recently invested in the domestic Indian island companies. If you look at flat seats per person, India is 0.13. China is 0.5. The Americans probably 3. So there's a long way to go as the Indian economies develop and rising middle class. So rising domestic consumption and operators. The last one, I probably mentioned that already, is the supply chain repositioning, the beneficiaries of what we call a more multipolar world, the likes of Vietnam, the likes of ASEAN countries within that context.
Shan, Asia is often described as high growth, but growth can come in many forms.
Yeah.
What types of growth are you most interested in today?
That's a very good question. I think we do think about from that perspective quite a lot. So as a long-term growth-focused investor, we try to have, I call it a flexible or a pragmatic approach to growth. Because Asia is a fast-growing area, the opportunities that comes with growth can be evolving. I mean, back in the 1990s, it would be Hong Kong financials, and 2000 would be Korean and Thailand shipping companies, for example, growing very fast. In the 2010s, with the first generation of social media and e-commerce companies from China. And in the 2020s, a lot of AI hardwares like Taiwan TSMC, the data center switches company Acton, South Korean Samsung Electronics, SK Hynix for memory chips, etc., etc. But that's evolving. So what we do look at is we focus on three very clear and persistent inefficiencies in the market. The first one we called underappreciated growth duration. So these are the companies who can grow much longer than market expected. So compounding with higher capex and reinvesting themselves. Number two, we call it underappreciated growth pace. These are fast-growing companies that in that fat tail. So probably the more conventional growth stocks, if you want to label that. So a lot of digital companies would be there. We see quite a lot of them in ASEAN, for example. They are doing what the Chinese e-commerce and platform companies have been done in the previous 10 years. So very exciting. And then the last inefficiencies we call growth surprise. So these are simply just growth happening when nobody is expecting a lot of growth from that sector of companies transitioning from lower growth to higher growth. A lot of the commodity companies fits into there. So think about the likes of copper, which a lot of these modern industrial companies will need quite a lot. Modern industries will need quite a lot, and there's a quite big supply deficit. So three different kind of growth flavors. At the moment, we're quite flat among these three, which normally happens when the team is most constructive about the asset class. So I'd say exciting opportunities in all three of them, which is what we like because your portfolio is not driven by one single type of growth driver or one single type of themes.
And China remains a significant part of the portfolio. How has your thinking evolved in China, and what gives you the confidence to remain selective rather than step away?
Yeah. Your last bit is very relevant here, is remain selective. We had been underweight in China for a couple of years, like up until pretty much mid-2024. And we've gradually increased our exposure there and turning from underweight to overweight more in the more recent 12 to 18 months. I think the things that we've been encouraged is one is there is a very decisive policy shift since September 2024, where the policy mix has shifted towards a lot more supportive for growth. And then regulators are quite coordinated in terms of supporting for private sectors, etc. as well. That's number one. Number two is innovation. So what we've seen is with our local colleagues in Shanghai is that grassroots level innovation are really taking place. And when you think about innovation at a scale, China is the second largest economy in the world. So the scale, the innovation at a scale would really have amplifying impact in terms of corporate earnings, potential new opportunities, etc. So our assessment is that there are actual growth that can be captured by active selection when you think about China as one of the deepest and most dynamic market in our investment universe, where you do need to be very focused and selective in terms of policy alignment and profit motive at the same time. So that in China has been a very key crucial point in terms of our stock selection.
And finally, Jeanne, but before I let you go, when you look out over the next 5 years, where do you think the most exciting growth opportunities in Asia are likely to emerge?
Yeah, very good question. We are doing a lot of groundwork research for future opportunities in areas like autonomous driving, areas like more AI application. How would AI diffuse to broader industries? I mean, very differently. If you look at US and China or broader Asia in that sense, the US companies are competing to the most frontier technology of AI, the best models, the best computing. But in China and in Asia sense, it's a lot more focused on quick adoption and diffusion to the wider range of the economy. So AI application would be one area we are very interested in to see what would be the industries and companies who can best utilize that to increase their productivity, efficiency, and bottom line. So that would be another area. The next one, I mentioned that already, we are quite positive on Vietnam. So as a sense, it's the largest off-index investment in the portfolio. And it's also got to the emerging market status from a frontier markets status by FTSE index, which is quite encouraging. Domestic economy is seeing a turn with the new political leader. So they've probably got double benefits from a more multipolar world from a trade perspective, and the domestic cycle is turning around. So new technology areas like autonomous driving, more interesting in the potential AI application to the broader economies, and frontier on newer markets like Vietnam.
Well, Jeanne, thank you very much for your time today.
Thank you.
This is a high conviction growth fund with the ability to move around as different parts of the market, such as more cyclical sectors, exhibit growth, benefiting performance as a result. For more information on the Baillie Gifford Pacific Fund, please visit FundCalibre.com, and don't forget to subscribe to the Investing on the Go podcast, available wherever you get your podcasts.
Please remember, we've been discussing individual companies to bring investing to life for you. It's not a recommendation to buy or sell. The fund may or may not still hold these companies at the time of listening. Elite ratings are based on FundCalibre's research methodology and are the opinion of FundCalibre's research team only.